All right, thanks, Matt. Yeah, so let's kick this off. This is going to be a combo here, strategy focused discussion, teaching you the ins and the outs of a vertical spread, and then I'm going to apply it and show you kind of why I think ARK is a good case study right now. So let's start with this idea of a vertical spread for a second, and in fact, to preface that, spreads in general, remember that you have call options and you have put options, and you can buy them or you can sell them, which gives you four core trades. You could buy a call, you could buy a put, you can sell a call, you could sell a put. Those are the four basic building blocks of the options market. And buying calls and buying puts is fairly simple, fairly straightforward. The issue that you might run into is they get expensive sometimes, especially in higher volatility environments, and they move really quick. It's interesting, when you learn options, you learn how to buy a call first, you learn how to buy a put. That's your first bear trade that you learn. So normally, like in everyday life, you learn how to crawl before you learn how to walk. You start with maybe safer things, and then you get to more dangerous, more risky things. But not so in the options market. Buying a call might be the simplest thing you can do, but it's also the most aggressive. So from a conservative versus aggressive standpoint, it's kind of flipped on its head. We throw you in the deep end, and we teach you the most aggressive thing you can do, buying a call option, because ironically, it's the simplest thing you can do. So we're putting a premium on simplicity over emphasizing something that's more conservative. So as you learn the basics of a call and a put and realize, man, these are pretty aggressive plays. Like, I make money quick, but I lose money quick. There's a lot of leverage. You'll get to the point where it's like, I want something that's a lower octane trade. I want something that's a hedged trade that is less risk, and maybe doesn't move as quickly. And that's what gets you into the world of spread trades. And conceptually, all you're doing when you do a spread trade is you buy one option and you sell another against it. So you're simultaneously buying one call while selling another one, or you're buying one put while selling another one against it. And because you're on both sides of the equation here, you're buying an option, you're getting all the characteristics, all the Greek exposures that you get when you buy options, and then you're offsetting that by selling an option. You're getting all of the exposure to kind of the opposite Greek positioning with that. So we call it a hedged trade because it reduces cost, reduces risk, reduces exposure to the different variables that impact the trade. Well, there's a million different ways you can buy and sell options. So there's dozens and dozens and dozens and dozens of different spread types, but we have these classifications, these buckets that we group them into to bring order to the chaos and organization to what would otherwise be like a pretty complicated discussion, because there's lots of different things you can do. In bringing organization and creating buckets, one of the ways that you can categorize the spreads is based on the months that you buy and sell. Buying 1 month versus selling another, or buying and selling in the same month. Those are two different things. If you're buying and selling in the same month, if you buy a May call option and you sell a different May call option against it, you bought May, you sold May, same month, we consider that a vertical spread. So by definition, this is buy and sell a different strike price. If you bought and sold the same thing, there's no position. I'm not buying a May 50 call and selling a May 50 call. That would undo what I just did. So it's got to be a different option you're selling against the one you purchased. Well, if it's a different strike in the same month, then that's a vertical spread, right? That's the definition of a vertical spread. And there's four of them. There's a bull call spread and a bull put spread. Okay, those are the two bullish variations, which this is intuitive. Listen, you buy one call, you sell one call. You can do that in a bullish fashion to create a bullish trade. What else can you do? Well, listen, there's calls and puts. That's it. So the only other thing you can do is buy a put and sell a put and do it in a bullish position to create a bull put spread. That's the only two ways you can combine these in the same month and be bullish. Or you can do it and create a more of a bearish play, which is a bear call spread and a bear put spread. So again, calls or puts, bullish or bearish, that's 4 different ways you can create it. And so, I mean, I can talk about vertical spreads for a while, but what I want to focus on here is the bear side of the ledger. Okay. So we're trying to create a cheaper trade, limited risk trade, a hedged trade, so it doesn't move as quickly, but we're doing it with a bearish tilt because of what just happened today, right? So I wake up, I see, oh, Mr. Market, you're misbehaving. I'm not going to illustrate a bullish trade, not with the way the market looks right now. And I suspect most people already have bullish trades going because the market's been in an uptrend. So the more interesting discussion to me today is, hey, suppose I'm now in the market for a bear play. What might I consider? Well, ARK to me is low-hanging fruit because it's breaking support, it's rolling over. There's a lot of bearish technical considerations here. So we're going to go bearish. The question is, which one of these guys do you want to use? And to Matt's point on his intro, well, what is the difference? What is the difference? What I like about explaining the difference between these two, bear call and bear put, is it illustrates a broader recurring theme that you'll see in the options market, which is this eternal trade-off between probability of making money and how much money you actually make. If you want to make a lot of money, go buy a lottery ticket, okay? If you win, you're going to make a lot of money. But you understand as well as I do that it's a very low probability bet, okay? Make a ton of money, but like a 0.00001% chance you're actually going to win, okay? That's one extreme end of the spectrum. Well, the other end of the spectrum is, hey, I want to trade where I have like a really good chance of winning, like 80%, 90%, 95%. Okay, well, we can create that type of position, but you're not going to win like lottery ticket winnings. You're going to make less. And so these are always on opposite sides of a teeter-totter. You have a high probability of profit, but a lower reward or lower payout. Okay, I like the alliteration, high probability, but lower payout. Or we can get you a higher payout, but it's going to come with a lower probability of profit. And the easiest way to understand why you can't really break the link here and get a high probability of a high payout is because there's somebody on the other side of your trade, okay? And he or she is not an idiot. All the idiots have already lost all their money and gone away. The only people left to play are those that are actually rational and logical and won't take stupid bets. If you have a high probability of making a little bit of money, the person on the other side of your transaction, if we're assuming this is what we call a zero-sum game, they have a low probability of a high payout. It's the only reason they would actually take the other side of your position, okay? And so you can't really break the link between the probability and the payout. Where this comes in with the vertical spreads is one of these vertical spreads gets you on one side of this, the other gets you on the other side. So if you want a high probability of profit and you're willing to accept a lower payout, that's going to correspond with the bear call spread. That's one reason why you might use that particular spread to go bearish. If on the other hand, you want to go for the gusto, you want a little bit higher payout, okay, a little more cheddar, you're going to have a lower probability of profit. And the bear put spread is the one that gives you that type of trade-off, right? Now, there are other considerations we'll talk about in another segment, but that's the gist of maybe what might motivate you to do one of these versus another. I'm going to assume we want that high payout, okay? And part of it might be because we're more bearish. We really think the stock's going to go down a lot, and a bear put is just a better way to capitalize if that happens. Now, what am I, 10 minutes into this now, and I'm just getting to the bear put. Well, I'm going to give you the condensed cliff notes here on the bear put spread. The idea with this bear put spread is you're going to buy a put option. And usually you're buying like an in the money or maybe an at the money put option. And quite frankly, you could stop there. You could just say, ARK, you're terrible. I'm buying puts. Okay. But then you're like super aggressive, right? More expensive, more aggressive. And so maybe you want to chill out a little bit. You're like, well, I'm bearish, but I'm not like, I don't think it's going to zero. And even if it did go to zero, I want a cheaper cost. I want to offset my risk a little bit. I want a hedged trade. So I'm going to offset the cost of buying that put by selling an out of the money put option against same month in the same month, because again, it's a vertical spread. So if I take a look at ARK, I think the chart speaks for itself. Hopefully you guys can kind of spot where our head's at with this. ARK looked great a couple of days ago. It was tracking nicely, nice little bullish reversal above the 9 EMA, broke the 50, and then just when everybody's like, oh, ARK's coming out of the cellar, it's on the move. Rug pull. No, you idiots, it's not. Right back down. It's a shame. It's a shame. We've had so many failed recovery attempts in ARK. It's getting exhausting at this point. But look, it doesn't look great. It's back below the moving averages. Yeah, it's dropped a lot in the last 2 days. But you know, $50 is the next support level. So if they want to keep unwinding this, they could, and it's got room to drop. That's the technical pattern I think a bear put fits. So I'm going to go to the trade tab. Which month you buy? Here's the rule, or not rule. Here's the principle. The principle is longer term, more conservative. Going to move a little slower for you. Okay. Make money slower, lose money slower. Shorter term, more aggressive. Going to make money quicker, but if you're wrong, you lose money quicker. I think 2-3 months, good ballpark. I'm actually going to go more aggressive on this puppy, and I'm going to go May. Okay. It is more aggressive. It doesn't give me as much time. You could do further out if you wanted to. Well, ARK moves a lot. I mean, if I buy $62 stock, if I buy the May, 62, like at the money, it's $5. It's almost 10% of the share price. It's expensive. Like, listen, I'm no dummy. I'm not going to pay $5 for this thing. Not aggressive enough. I don't want to pay all that monies. So I'm going to offset the cost by selling a put against it. So I'll buy the 62 for $5.20 or so. And I'll sell the 57 against it. Create me a $5 spread. So I pay 5, sell the 57. I receive 3. I can hold the control key and sell it, and it'll smush it together with the long put. I just cut my cost from 5 to 2. Pretty good. I cut my cost, I don't know, what is that, 60+%, right? Now I'm risking $2 instead of 5. I'm paying $2 instead of 5. I'm risking $2 instead of 5. Maybe I said that twice. At any rate, this is now a cheap trade. And the risk reward is also quite sexy because I can make $5 minus my cost. So I'm risking 2 to make 3. It's 150% potential return. So sure, I'm limiting my gain. This is a limited reward type of trade, but it's substantial, 150%. If this gets to 57, dude, I'm not asking for much. It dropped almost $5 just today. I'm not asking it even to get to 50, get to 57 and I'll be A-okay. I think that's a fair bet given the bias and given the pattern. And so there you go. Okay, there you go. Bear put spread, the more aggressive of the verticals. That's how it works. That's how you build it. That's why you might build it. And that's what I think is a good case study, good example on an ETF that's just getting beat up right now with a good little risk reward.